Hi everyone, Francis Fruit here. Thank you very much for joining me on today's webinar on multifamily apartment investment. I would also like to say hello to people who signed up but couldn't make it today, and they're going to watch the recording later on. Again, I'm grateful to all of you. So before getting into the webinar, I'd like to mention a couple of disclaimers or disclosures here that what I'm sharing here with you is just for informational and educational purposes and does not constitute any investment advice. And I'm not selling any securities to anyone here. And whatever I share is not considered professional advice. When it comes to making any investment decisions, please consult with your CPA and attorneys for any, again, tax or legal advices and or financial advices here. Investments are risky, and it's important that you, as the decision maker, understand all the risk and also understand that the numbers that I am using as examples here, they're examples. There are not any earning guarantees, and I may make some, forward-looking statements here that again, they're just for educational and informational purposes. I'm not affiliated with any group, and any views that expressed here, they belong to me. And please do your own due diligences on any investment. And finally, by attending this webinar, you're consenting to be recorded, and I'm going to use that information maybe in parts of my publications or social media and audio and video format. That here are the topics that I'm going to cover today. A little bit of intro about me, why this webinar and why now, and talk the importance of mindset and goal setting before getting into the real estate. And in real estate, I'll be covering different types of real estate and why multifamily is my favorite investment vehicle. Different ways to invest in apartments, how to analyze them, and how I built a $50 million asset under management portfolio in, like 4 years, 4.5 years, on the path forward here. So, Francis Fruit, I grew up in Canada, went to school, got a couple of degrees. I probably could have become a medical doctor based on the number of years of schooling. But anyway, received two bachelors in civil engineering and geophysics and a master's degree in geophysics. And then I went to work in earthquake seismology, mining, and the oil and gas industry. And about 17 years ago, got hired by Baker Hughes. They moved me from Calgary to Houston, and I started working in the U.S. Last company I worked for was Marathon Oil, which was sold to ConocoPhillips, by the way, last November. I was let go from that company in the beginning of the COVID-19 when the oil price turned negative, $55 a barrel. So why did I decide to make this webinar? Well, first of all, it's the beginning of the year. We talk about goal settings, and I'm really hoping that with this webinar, I can inspire you to ask better questions. Think about where you are in life and where you want to be by the end of the year, and in the near term and maybe long term. Set appropriate goals, have a clear vision, set proper goals, and make 2025 your best year ever. And the second reason is that you might have heard that there is a 2.3 to $3 trillion of commercial debt maturing between now and 2028. And the opportunity is that a lot of these commercial real estate debt, they were signed with an interest rate between 3 and 4%. Now, in this current regime, current market, they have to be refinanced at a higher rate, somewhere between maybe 6 and 7%. And this means that most of these properties, they're going to lose a lot of value, and a lot of these borrowers will lose, a lot of money. And that becomes the opportunity for investors like us, to take advantage and kind of be able to jump on these opportunities, as they come. And yes, so this means that I see the light at the end of the tunnel. This train is coming. So mindset, the importance of mindset. When I was in grad school, about to finish my master's degree. Everybody, was congratulating me and say, hey, you're gonna land a job with six figure. And I thought, well, this is great. That was a big accomplishment. And I did start a job at actually $105,000 a year, about maybe, I don't know, like 17, 18, 20 years ago. Well, longer than that. Anyway, uh, but when I started, after I received my first paycheck, I realized that, well, wait a minute, no, this is not six figure, this is five figure, because I was paying probably like 30, 35% income tax on that paycheck. The other point was that I never thought where I want to land, on the six-figure salary spectrum. It's a wide spectrum. Six-figure goes from $100,000 to probably 999,999, right? I mean, that's not probably, definitely 99, like short of $1 million, and didn't think about the career path that I was taking, where I was going to be after 5, 10, 15, 20, 30 years of spending time, in that industry. Um, so in my career, 2015, I was working for a company in Houston, public company, and because of the cyclical nature of the oil and gas, the company decided to do a massive layoff. In fact, 60% of the work staff got laid off in one night. And it was in September. I remember we went down from 1,500 employees to almost like 500. And it was painful. I was put on a deferred layoff list. So even though the layoff happened in September, my last day in the company was end of December that year. Although I survived that layoff and I got extended six times, to work, on a month-to-month basis. It was interesting to me that right after the layoff and after the dust settled, the CEO received a big bonus package from the shareholders, major shareholders. And I thought to myself that, okay, so how come 60% of the staff is let go, but then the CEO receives a bonus and the company continues working, as if nothing had happened? So I started my development, this personal development journey, by asking questions that, okay, so how are these decisions made? How the system is put together, and what can I do? Because I kind of felt that I was commoditized, and I was. Then in 2019, working for another oil company, a colleague of mine, more senior, opened up to me and kind of shared with me that he had been able to replace 80% of his ordinary income through investing in 4,000 apartment units across the United States. I said, wow, that was the aha moment for me. I said, how did he do that? And we had a conversation, and that kind of was the beginning of my apartment investment journey. After I started digging and asking questions, I realized that I kind of was trapped. I was trapped in the the conformity trap. This was basically the conformity trap, limiting thoughts and belief that was given to me by my family, by my relatives, later school, society, teachers, etc., etc. Because I'd been raised in a middle class family. We never talked about money. We never talked about investment. Money and discussion about money was not a comfortable topic. And I know that my family, they were risk averse. They always talked about, hey, business and business people are risky. And the better way, safer way, more secure way is to find a job. Go to school, get good grades, land a good job, with good benefits like pension, now 401k, and so on and so forth. Like paid vacation. And basically, they taught me to seek financial security through education and finding a job. Um, and I know that probably for quite a while we had the lack mentality instead of abundance. I heard many times that from my dad that say, hey, no, we can't afford this, no, we can't afford having that, or like, do you think that I have like a money printing company, or no, comments like that. And we always resisted change. Even though we're living in a very dynamic world, well, we resisted change. So I kind of ended up in, in a system that I started selling my time, clocking in, clocking out, came up with or incurred some student debt. And eventually, when I was let's go, I realized that I've been commoditized. So a degree is commodity. Yes, there are lots of skills that we develop at school and university. I'm not suggesting that it's not a good idea to go to school, but my suggestion is to be financially educated. Like financial literacy is something that they're not taught in grade school or in colleges or in high school. So this whole system is the conformity trap. That's what I mean by it. Throughout my journey, I read many books. In fact, I decided to read 2 books a week for like 6 to 8 months, and I did. I started with some of the classics. I would say like Think and Grow Rich by Napoleon Hill. The Richest Man in Babylon. These are some of the financial literacy and personal development classic books. Rich Dad Poor Dad by Robert Kiyosaki, Tony Robbins. Books like the secrets of the money thinking in systems, and like secrets of the millionaire mind, and so on and so forth. And also took a course by John and Missy Butcher, the creators of the Life book, that they talk about the 12 dimensions of life, which like finance and career, there are only two of them. So I realized quickly that mindset and philosophy of life is everything. Basically, with our philosophy of life, we determine how our life is going to work out for us, and we have two options. Simply put, either we can design our own life, on our own terms, and work hard for it, and try to achieve it by being, smart about our decisions. And once we know where we want to go, and or follow someone else's path and someone else's plan. And if in the latter case, definitely the people who have planned their own life, they're not going to think about us, right? So the fundamental questions that I came across is, and the mindset was that, hey, who I am really, where I am, and who I want to be, to become, and what I want to be. So if I wanted to become a millionaire, what needs to happen or shift in me in order for me to be able to think like a millionaire? The idea of the mentality of abundance versus lack. And then being having gratitude and being grateful for what we had in life, and know that we're living in a very abundant universe. Learning to design the life, it's an ongoing process. It never stops. And of course, part of it is to invest in the personal development. As Jim Rohn's mentor Errol Shove said to him, he said, "No, Mr. Rohn, become a millionaire not for the $1 million, but for what it will make of you to achieve it." And this is very powerful. In terms of the mindset and freedom, financial time, location freedom, it's not really money that we want. It's really freedom that we want. We all want freedom, but we may not realize that. We may think that this is just like money. Um, but like the pandemic really showed us that, hey, how freedom of location is important to us, and people started moving around, migrating, even like from country to other country, and working remotely. But in terms of the financial literacy and financial freedom, that we're talking about. One of the powerful kind of figures is the cash flow quadrant from Rich Dad Poor Dad. Where he talks about there are multiple ways to earn an income or to have an income. One is earn income as an employee on the top left. That you sell your time basically, and you have a job, and you pay the highest taxes, in this country for it. The second group are self-employed people that, they own a job basically, but they still need to spend their time to make money. A doctor, a lawyer, a dentist, they cannot make money without investing. Of course, they cannot make money, with their degree and their title without really working. On the other hand, business owners, there are people who have figured out to create a system or own a system that would allow them to employ people that are smarter than them, and put them to work basically, and have them kind of help them like reach their goals, the business goals. And the last group are investors. After business, when you make a lot of money, then you want to invest the money. Basically, you want to have your money work for you when you're sleeping, and that's the category that's is the optimal way to make money. And by the way, passive income or investment income, you pay the least taxes on it, in this current regime. And the whole idea to reach financial freedom or time and location freedom is to be able to go from the left-hand side or left quadrants to the right quadrants. And in this context, it's important to understand that even though we think that our hourly wage or salary is whatever, we're not paying for time. We're really getting paid for the value that we bring to the marketplace, and we get paid for that value. Not really the time. And the more value that we can create for more people, the higher the payment and the reward will be. And in that regard, if we really be able to create or invest in scalable income streams, cash flowing businesses over time, that's really the holy grail of reaching financial time and location freedom. And in order to do that, we obviously need to maintain a growth mindset by continuous learning and adapting to this ever-changing world. In terms of mindset and goal setting, definitely we need to understand, where we are, what we want, and how long will it take for us to achieve them, and how can we accelerate that, shorten that time, and how. The mindset shift, the paradigm shift is that instead of thinking in terms of security, we need to think of freedom. Even if you decide to go and work in a job, then don't look at it as a way to earn income. That's the secondary product. It has to be something that you learn, a skill set, connections that will help you to reach financial freedom later on. If we decide to think like a millionaire, then we need to educate ourselves. We need to probably find a group of people, like a group of millionaires, to be exposed to them, and learn from them. And that's why Jim Brown said in one of his talks that we are the average of 5 people that we spend the most time with. So we need to choose wisely. So that community matters a lot. We need to understand the rules of investment. That hey, how does a millionaire think about investment? Never lose money. They invest in cash flowing business that appreciate quickly over time, and we can't really afford getting rich slow. We have to get rich fast. And the other mindset shift is about risk, because a lot of people, they have this cliche that businesses is risky, investments are risky, stock is risky, real estate is risky, everything is risky, driving is risky, life is risky, we're not going to get a life out of it, right? But it's not really the investment that is risky, it's the investor that is risky. The investor could be the asset or the liability. And that's the key, that investor that does not have the enough knowledge and expertise or experience, and they don't understand the risk of the decision they're making, so they're going to make a bad decision probably. So again, it's the investor. And in order to avoid that or mitigate that or to reduce that risk, we need to educate ourselves through working with mentors, developing skills, getting educated, attending webinars and seminars, and being part of communities with, again, like-minded people who have done it. And ultimately, it's not really about how much money we're making that makes us rich. It's about how much money we can keep, and the more money we make, the harder it'll get to keep that, and that's why we need to get educated. Let's say if you have the mindset and we switch the mindset, we want to to reach financial freedom, then we want to put some smart goals, like maybe for 1 year time frame, 3 year to 5 year to 10 year, 20 years. So we need to plan, we need to design, and part of designing is really asking good questions. What type of lifestyle do we want to have? If we have, our goal is to leave our day-to-day job and start our business venture. How much money do we need to have? Or about kids' college, or for some people maybe, hey, how much do I need to retire comfortably? So these are good questions to ask, and in order to answer these questions, we really want to have specific answers. And once we have those specific answers, we can measure, we can estimate how much it would cost to achieve those answers. And does it make sense? Let's say if I want to own like jetliner, Dreamliner in 1 year? Is it achievable? Is it attainable? Or maybe it takes like 20 years, from now to achieve that. Is it realistic, right? I want to own maybe a piece of land on Mars. Is it realistic? Can I do that? Maybe in the near future they start selling, these planets, but you get the idea. And it has to be time bound. So that's why it's important that we categorize our goals, to short term, mid term, and long term goals. And once we have those, with those specific uh, measurable, attainable, realistic, time-bound goals, then we can estimate how much it would cost to have those experiences today. And a simple calculation is to assume an inflation rate of 3 to 5% a year, and just like forward calculate what it would cost. Because the value of money is going down, every day. $1 today worth more than $1 in a year from now. So here's an example. The inflation. Let's say you want to have $100,000 a year, toward your goal or standard of living. How much do you need based on a 3% or 5% inflation rate in 25 years from now, by 2050? So $100,000 today is kind of equivalent of $210,000 in 2050. Excuse me. And 300 and like almost $40,000 with a 5% inflation rate per year in 2050. So, you get the idea that how much money you're going to need. So, based on that, you can fine tune your assumptions. And let's say that, again, with $100,000 passive income, this is what we want to reach. So, how can we reach that? So, if you had $2 million cash today and you had put it in the bank in a CD account at 5%, there is your $100,000. Or maybe if you can invest your money, at 5% annual return, or get some dividends back from somewhere, oil and gas, royalty or whatever, else, you would get $100,000. You can buy a business all cash with $2 million, and if that business generates $100,000 of net operating income, like this is an example of apartment complex, then you would get your $100,000 of passive income. But maybe for some of us, if you don't have the $2 million cash, so what else we can do? I guess the most important thing is that start today, because there's no better time to start, and the highest risk is for people who don't take any risk. So start investing today with any amount of cash that you have, because you want to have that experience. You want to be exposed, and create or invest in like cash flowing assets. If you're good in writing, let's say write a book. If you sell that book, make some money, that becomes a cash flowing asset. Like real estate is one of them. Maybe there are other vehicles for other people. Some people, they love crypto, or they love stocks, or whatever that is. That vehicle does not matter. Whatever you feel comfortable and you understand it, start investing in it. The power of leverage. Don't forget the leverage. This is specific to real estate. I guess that may not apply to bonds or stock or mutual funds and things like that. So in real estate, with every $1 that you put in, you can get $3 to $4, depending on where you're investing. If it's cash flowing asset, definitely, and definitely invest in your own personal growth and education. Investment is a team sport. Remember that. You need to have a team. You can't just do it all yourself to save money or save time. Remember, you can't really get rich slow. In order to accelerate that, you need to have a team of experienced people, mentors with practical knowledge, not just paper knowledge. And you need to be among like-minded people. Remember, you're the average of 5 people that you spend the most time with. Let's talk about real estate now. So, different types of real estate. No, it might be interesting for you to know that lawmakers in the House or Senate, the Congress, they all invest in real estate investment, and probably, real estate investment is the number one vehicle that these folks they invest in. So guess what? They definitely make the laws more favorable, toward those asset classes, which includes real estate. So this is kind of a list of different real estate types. I'm not going to go through all that. Just wanted to mention that there's more than one. In particular, to related to our conversation is rental duplexes to fourplexes. So some people they are interested in those, and these are not commercial. These are considered residential, and anything with 5 units and above is considered commercial, and that impacts kind of the financing that you can secure. But there are again other types of investment subtypes or asset classes. With regard to the residential versus commercial loans, these are a couple of like differences. And the most important thing is that when you go to get a residential loan or mortgage, they look at your W-2 and of course your credit worthiness, your background, credit score. But when you go to buy an apartment complex, for instance, and a commercial loan, they look at your balance sheet, they look at your net worth, basically. They want to know what's your net worth, assets minus liability. Let's say if you want to borrow $1 million on an income-producing real estate piece, they don't care about your W-2 job. They look at your net worth, and if your net worth is equal or greater than the amount of loan, and if the business plan is robust and you have the experience, you can get it. But other than that, the amortization, for both loans and the residential and commercial, they're pretty similar. The second biggest difference is the term. The loan term is for mortgages like 15-year fixed or 30 years or ARM, but for commercial, they vary from 3 years maybe to 20 years. And even though the amortization is on like maybe a 30-year basis, still the rest of the loan is balloon at the end of, let's say, the term, 3, 5, 7 years, whatever that is. So why apartment in particular? So in order to answer that question, I'd like to, mention a couple of things. So first of all, if you look at the Warren Buffett's rules of investment in the context of apartments, here's ours. So Warren Buffett's philosophy, general philosophy, is that, hey, let's use a depreciating asset such as cash to purchase appreciating businesses that generates cash flow, like apartments. And there are like 4 rules that we can talk about here. So rule number 1 is that business cannot be or should not be easily replaced. So apartments are not easily replaced, because once an apartment is built, the lifespan of an apartment is like, I don't know, like maybe 40, 50 years, before they redevelop it. And the cost of replacement is getting higher and higher. So it makes sense in today's market or any market to buy a 20-year-old apartment complex, fix it up, improve it, upgrade it, and increase the rent and increase the the cash flow on it. You can't really build a 20-year-old apartment, right? So it has to be brand new apartment. Second rule is that it has to produce positive cash flow, and apartments generally fall in that category, that they generate positive cash flow unless they're going through some financially distressed situation that does not generate positive cash flow. The third one is income appreciation. So income appreciation is something that is kind of you generate, you force it. You don't wait for the market to go up and down. If the valuation is based on income, then which is true for apartment complexes, you can easily, let's say, double your money in like 4 to 5 years, 6 years. And number 4 is the power of leverage. That does not apply to anything other than real estate, like stock and other things like paper assets. You can leverage, and usually, if you use $1, you can borrow maybe $3 to $4, and that will increase your return and your borrowing capacity. Again, we talked about it, that apartments are not paper assets, they're real assets, they're cash flowing businesses. Apartments are businesses, they're not just brick and mortar. And appreciation is based on the generated income. That makes a huge difference. Here's an example. If you think of a 50-unit apartment complex and you decide to do a rent increase of $20 per month per unit, right? So that $20 rent increase per 12 months times 12 times the number of units, that translates into an added value of $240,000 based on a 5% cap rate. Okay, so that's how much value you're adding to the property when you do the rent bump. And number 4, again, like the favorable leverage option is 65, 70%, 75% of loan to value. That's how much loan you can get for these properties. Um, the other reasons is that there's a shortage of affordable housing. Workforce housing is an issue. Housing in general is an issue, in this nation. Because of that, we're seeing the decrease in home ownership because it's getting more and more expensive, to buy a house. And the other reason is that 80 plus million baby boomers are moving to rental apartments, assisted living or regular apartments. There are lots of tax benefits. Again, it has the cash flow portion. You can double your money in a couple of years, 4 to 5 years. And historically, in the last maybe 20, 25 years, rental properties, they have outperformed stock and bonds. And, this is like the primary residence. We're talking about the places that people need to live. Right? They need a shelter. They need a functional, clean, space that they can call home. So it's not just again like walls; it's the home of people, and apartments uh, is a great way to provide that, especially in the workforce, workforce like housing. We talked about replacement cost, and one other point is that if you make some profits from a cash out refinance, from an IRS standpoint, that is considered a loan and it's not income. So there are some tax advantages, in that as well. As we said, the apartment is a business, and if you think about it, if you go to your bank, Bank of America or Chase, and say, "Hey, Chase, give me a loan. I want to buy your own stock." They say, "No, I'm sorry, no, we can't do that." But if you go there and say, "Hey, I want to borrow money to buy an apartment complex," they say, "Okay, so give us your business plan and your net worth and everything. We're going to consider that." And the reason is that again, an apartment is a business with a cash flow, and it's not really like a rental single family home because an apartment complex, if it's bought at the right scale, it's going to cover all the operating expenses and debt services, and still you can make some profit. Three ways to invest in an apartment complex. You can do it yourself. You can just look for a deal, find it, find financing, close it, and operate it. You can invest in REITs or real estate investment trusts or partnerships in a trust. And then the third one is partnership. So partnership, there are different ways. So these are like the three main ways that you can think of investing in an apartment. Um, if you decide to do it yourself, these are basically what you need to do. You find the deal, negotiate the terms. You usually put it under an LLC, secure financing, talk to brokers and banks and lenders. Once the deal is closed, you manage the property, find qualified tenants, taking care of the rehab, fixing the property, turning units. And this is like the three T's of rental homes: toilet, tenants, and termite. You either deal with it yourself, or you can hire a property manager. And then you also do the asset management. Basically, you monitor the performance of your investment, know how the money goes in, know how well you're executing your business plan. You protest the taxes, shop for insurance. You try to minimize or optimize the expenses. And you also take care of any reporting to lenders or banks if necessary. If you decide to invest in REITs, REITs are basically the shares of publicly traded or sometimes non-traded publicly of large-scale firms that they own cash flowing real estate assets, like shopping malls or like apartments or maybe storage units. So there are different asset classes that these big firms they purchase and they they make it so you can buy those shares through your any major stock exchange, your 401k, if you have brokers, mutual funds, and so on. And this is like an example of some of the REIT stocks that you can go and buy. So REITs are like kind of similar to maybe if you decide to buy the share of a gold mining company, versus buying the actual gold yourself. So instead of a direct investment, you buy the share of that company. And REITs, investment in REITs, might be a good cash flow yields, but overall they're not considered like a direct real estate investment. And you may not receive all the tax advantages of real estate investment. But again, to find out more, you need to consult with your CPA about those advantages and disadvantages. Partnership. So partnership, you can form a partnership yourself. You can do it with your family and friends. You do all the work that we discussed on the DIY slide, and you operate. You bring the sweat equity. Maybe other people, other your friends, that you partner with you, and you get the job done. There are syndicators or sponsors or let's say experienced real estate investors out there who, when they put a deal together, like a large investment opportunity, they present it to investors, and you can invest with them, and these are often, individual investment opportunities. One a specific property, and it could be anything. It could be a coffee shop, it could be, like a business, it could be apartment complex. So these are sponsors or syndicators. You can invest with them. Real estate crowdfunders or crowdfunding platforms that they started since 2012. They're another form that these are sponsors. If they become big, they can go to crowdfunding platforms, and for a fee, they can present and market their investment opportunity to bigger crowd. And also there are real estate funds or private equity firms that they pool a fund together, a pool of money from investors or debt investors, equity investors, and they invest it based on certain uh, set of criteria. So real estate crowdfunders, again, they're online platforms. Some You can invest in most of them with maybe as little as $500 or $1,000, and these platforms are both open to both qualified, accredited, and non-accredited investors. I'll explain that in a minute. And you can also invest as a debt investor and equity partner in these deals. But again, no, these are all online. The good thing about the crowdfunders is that um, at least on paper, they say that they mainly work with really big sponsors, people who have a good track record, and they have a due diligence process, but still they transfer some of the risk to you, so they do not take the risk of investment. They just try to vet the sponsor based on a certain criteria, but still understanding the risk and tolerating it, and uh, uh, basically doing the due diligence on the investment is on the investor side. These are a couple of examples: Yield Street, Fundrise, Realty Mogul, and so on. CrowdStreet, you might have heard of them. Farm Together, for instance, they only invest in farmland. A little bit of history on crowdfunding. So it was really jumpstart. Our business started back in 2012. Prior to that, good investment, big investment, private investment in real estate in particular were only available to qualified investors. And those qualified investors basically were high net worth, ultra high net worth, no individuals, families who could afford losing money. This is basically what the U.S. Security and Exchange Commission say, that, hey, we're here to protect the average investor, who cannot afford losing money and they don't understand the risk. So they came up with the term accredited investors. Accredited investors, it has a long list of definitions. One of them is people who have a net worth of $1 million, excluding their primary residence, or they have an income over $200,000 for an individual, or with a partner, they have like $300,000 in the last 2 years, with a reasonably expectation to get the same, in the current year and in the future. There's another term that is not on the SEC, but the sophisticated investor. It's a term that's it's a special status that people who are not accredited, so they do not have these qualifications, but they have the knowledge, then they have the experience through doing business or education, or working for certain companies. So they become sophisticated, and they're allowed to invest alongside accredited investors. Um, so some keywords before we get into how to analyze an apartment complex. So some of the keywords that you may need to know when you look at the financials are like the gross rental income. Gross rental income is, let's say, a theoretical rental income if the apartment was 100% occupied, 100% at the rental rate that the seller is reporting. So that becomes the gross rental income. The effective gross rental income is basically the rent that is collected, right? So let's say they say the market rent in this market for a 700 square foot unit, one bedroom, is $2,000, but then they're collecting $1,800, so they're below the market rent. So that's the effective rent. And Other income, such as maybe laundry fees or pet fees, late fees, ratio utility billing systems, parking fees, VIP, storage, bike kits, etc., etc. So these are like additional fees, amenity fees. Like some of these that trash valley, that that the apartments charges to add to the income. So the difference between the effective gross rental income so operating expenses is the any expenses that is related to operating the apartment complex, and that includes taxes, insurance, payroll, maintenance staff, and unit turns, housekeeping, things like that. The difference between the total income and operating expenses is called net operating income from the business. Physical and economic vacancy, in the example that I said, let's say it's a 100-unit apartment complex. If 10 of the units are vacant, this is 10% physical vacancy. But the economic vacancy is bigger than physical vacancy because, again, remember, if the market rent is $2,000, but if the property management decided to lease up the apartment, through a concession, they provided reduced rent, $1,800, so that $200 concession or reduced rate, goes toward economic vacancy. So it's important to understand what the categories under the economic vacancy. If it's bad debt, if it's like concession, or they're providing they're below the market rent. Why is that? Cash on cash is the return metric on just the cash only. Cap rate, again, is another metric. You can think of it intuitively as the percentage received on all cash purchases. CapEx is the capital expenditure. Anything that is not operating expenses is considered kind of CapEx. You replace the roof, you do the foundation repair, you replace the windows, fix the driveway, things like that. Some of these CapEx expenses, they translate directly to rent increase, like amenities. You build amenities through, some capital expenditure, and it adds to the value of the property, and you can increase the rent based on that. Others may not. Leverage, we talked about it. With every $1 spent, you get $3 or $4. IO is the interest-only period. It's very typical in commercial loan that, let's say you get a loan, and the first 2 years, you only pay the interest, not interest and principal. P&I is the principal and interest. DSCR, or debt service coverage ratio, think of it as a lender's safety factor that they want to see above the break-even income after debt services applied to the income. So imagine if you want to borrow $1 million at 7%, your debt service, assuming that it's only interest only, is $70,000 a year. And if the lender says, hey, I want a 30% safety factor, meaning that the debt service coverage ratio is 1.3, so you multiply the 70,000 by 1.3, which is $91,000, and that basically $91,000 is the bare minimum on the income that the lender wants you to produce, or that asset needs to produce, before they would lend you the $1 million at 7%. Property management fees and asset management fees are fees that are charged quite often based on the percentage of the rental income, but they're the asset management, sometimes they charge it based on the amount of cash that they've raised, or like they're different formula. So cap rate on apartment. So as I said, cap rate, is one of the important metrics when it comes to investment. To understand it is really the percentage return that an investor, would receive or would like to receive if they purchased the property all cash. Here's an example. So assume that the property value is $10 million and you're going to buy it all cash. So you write a check for $10 million to buy it. You start operating it. After 1 year, you see that you had collected $1 million worth of rental income, right? There had been some credit losses and some vacancies. Let's assume 10%. So your effective rental income is 10% of the $1 million, which is 100. So subtract that is $900,000. Let's say you collect other income through pet fees or laundry facilities or etc. So you end up with $910,000 of gross operating income. Then you pay out of that, you pay expenses. You pay property taxes, you pay insurance, maintenance, management fees, reserves, some salaries, maybe other expenses. So your total expense is $160,000. $160,000, so 910 less 160, you end up with $750,000. So this is how the cap rate and property value and net operating income is related. So property value is basically net operating income divided by cap rate, or cap rate is net operating income divided by the value. So in this case, that you purchased the apartment at $10 million and you ended up with $750,000 of net operating income, your cap rate is 7.5%, which is kind of similar to here in a cash on cash, in this example. So a back of envelope calculation for NOI. So when you receive, when you're looking at an apartment, without having really received the financials, right? So if you know an average income or monthly rent for that property, let's say it's a 200 unit, the average rent is $1,500 a month. So you multiply 200 by 1,500 by 12 months, then you arrive at $3.6 million. So this is the income, right? The total income. Then again, we talked about economic vacancy. So you assume a 10% economic vacancy here. So you multiply your income by 90%. So you bring down the income. This is kind of a safety factor. And you arrive at $3,240,000. The NOI here, in order to calculate the NOI, you have to assume something for your expenses. And expenses here, you can assume a number between 45 and 50%. So let's say 45% of expenses, meaning that you multiply your income by 55%, and you arrive at 1.782. Right? So this becomes your NOI. So in this example, if your NOI is 1.782 million, at a cap rate at 7.5%, the value of that property is $23,760,000. Right? This is just showing you an example of how, with the same income, if you change the cap rate, the value changes. So the cap rate, as it goes down, the value goes up. So properties with a lower cap rate, they're more expensive, less cash flow, less income basically, or less net cash flow for you. The higher the cap rate is less value and more cash flow. And also some investors, they associate cap rate with the risk. So lower cap rate means lower risk, higher cap rate means higher risk. So in that example that we arrived at an NOI of 1.782 million and assumed the cap rate of 7.5%. So the value of that property is 23,760,000. So just assume that we decided to buy that property all cash. So we write a check for $23,760,000 and we buy the property. So after 1 year, then you look at it, we collected 1.782 million of worth of NOI. So our cash on cash is that NOI divided by the amount of equity cash that we paid. So this is 7.5%, right? Now assume that instead of writing a check for 23 plus $1 million, we put 30% down. 30% of that amount is $7,128,000. So basically, you're going to borrow 70% of that money, or the amount, which is $16,632,000. And assuming that we're just paying interest only for the debt services at 6%, so 6% times the amount of loan, so you're paying around $997,000 of interest to the lender per year, right? So to calculate our cash on cash here, so remember the NOI was 1.782 million. Out of that, you're paying $997,000. And we paid 7.12 out of pocket, assuming for the down payment. So that divided by 7 million, we arrive at 11%. So that's why this is the power of leverage. Mistakes to avoid. So the first mistake, the biggest mistake, is not to invest at all. The second mistake, if you want to do it yourself, do not buy anything less than 30 units because it's not worth your while. This is practically speaking, right? So if you can buy anything more than 30 units, do it. When it comes to scalability and getting rich fast, single family home rentals doesn't serve the purpose. If you don't use too much debt, anything more than 80%, this is dangerous. And everyone could do that. Don't just buy based on, hey, lower price or cap rate. Really pay attention to the location, to the quality. If it's a good deal, you have to pay the premium, for the top deal, and it's better to get into great deals than just like cheaper deals. Use commercial brokers. It's a mistake that they say, hey, I want to save money, and I'm not gonna pay anything to the commercial broker. That money that you spend, they can save you a lot of money. They can save you a lot of trouble. Don't buy your first apartment. Don't buy the very first apartment that you come across. You need to look at enough deals, maybe 20, 25, 30, 40 deals before you land your first apartment if you want to do it yourself. Know your market if you want to do it again yourself. Know your market. Know what you're getting into. Look at the growth rate, population rate, economic rate, all those metrics. Understand your market. Don't buy all cash. You need financing. Get the leverage. Even in a regime, in a financing regime, like today that the interest rates are higher, you can still structure financing in a way that would make sense. Don't wait for the best time because no one can time the market. No one has the crystal ball. They can always estimate or predict, but all predictions are wrong. And don't shop around your lender if a lender tells you that, hey, I'm not going to lend you money. So understand why. Okay. Specific note on financing: there are different lenders out there. Agency, Fannie Mae, Freddie Mac. So you've heard those names for mortgages, residential mortgages. They're the same lender, for commercially backed securities. Commercially mortgage-backed securities, for commercial loans as well, and they have representatives that work directly with Fannie Mae, Freddie Mac, so you can work with them. They're banks, they're life insurance companies, credit unions, and the housing and urban development that they provide a lot of loans to developers, builders, and to some apartment owners. Majority of loans are DSCR constrained, based on what we discussed. For most lenders, the minimum DSCR is probably 1.25 to maybe 1.4. For HUD is a little bit different, might be a little bit lower at 1.15. Again, remember the DSCR is a safety margin, so you want to calculate that DSCR. You want to, calculate the NOI based on the DSCR. You always have to be staying above the DSCR. So it's a safety metric both for the lender and also for you. Again, last but not least, we talked about it, that the lender, they look at your net worth and your ownership and management experience, and the net worth in most cases has to be equal or greater than the loan amount. Where to find apartments? 80% of apartment deals in any major market are only done by a handful of brokers, and those brokers, they don't show up on a Google search, by the way. So these brokers are maybe like CBRE, Newmark, Marcus and Millichap, IPA, Collier, JLL, and so on and so forth. And there might be a secondary private brokers, like say in Austin, Muskin and Lamb, and there are a couple of other groups that build relation. You need to build relationship with them. But anyway, look at your local market in the beginning, to find those apartments. If you want to do it yourself, the criteria for your first deal, I would advise find something that is above 30 units. Location always matters. Find an apartment in a good location, and be willing to pay a premium for it, to some extent. Make sure that it has a cash flow, positive cash flow of at least 4%, without any upgrades before you do any value add. Do not leverage more than 75%. Definitely work with the property manager. Remember the DSCR rule, and know your break-even numbers and occupancy. You need to reserve at least $300 a unit per year. Just assume in your analysis that property taxes are going to go up to 100% of the market value always. Get an actual insurance code. Insurance has been crazy in the last couple of years, so it's important to know the exact number or actual number. Again, lender is your friend. If a lender doesn't lend you, understand why. Talk to them. They have a lot of data points. They see a lot of deals and look at lots of properties. Uh, Assume no income increase in the first like couple of years because the market like Austin, for instance, or Dallas, the bigger properties, they're experiencing a maybe 5 to 10% rental decrease instead of increase. So assume no income increase. Stress test your deal. Question expenses, income expense to income ratio, anything below 40% or above 55%. Overall, understand the financial report, the profit and loss statement. And if you're deciding to do any obvious repairs or any capital expenditure, it's better to have that number. I mean the cost for the next 3 years. Uh, know your numbers again. Know commercial broker. Look at many deals before landing one. Loan size the deal. Talk to lenders. Show them your assumptions. Ask them for their feedback. With your smaller deal, if it doesn't generate at least $2,000 a month of net cash flow for you, it's not probably a good deal. It's not going to be worthwhile of your time and effort. Have a solid exit plan. Again, remember, an apartment is a business. It's not a single family home. Before you enter it, do some scenario testing, and test your assumptions and come up with a plan. Hey, how you want to exit it? You want to exit it after 5 years, after 10 years? What is your business plan for that? Do you want to, what are the things that you want to fix in that apartment? You want to upgrade. How much rent you can increase and why? And how do you know that? Um, and always, use the principal and interest in your debt service calculations and underwriting. And assume at least 18-month, maybe to 24-month break even, no cash flow. And if you have investors, family, friends, under promise and over deliver. Briefly, this is the underwriting process. So you need to kind of know the submarket as we talked about it, know the location, know the the drivers, employment, population growth and things like that. There are websites like cd-data.com that you can look into to get the general insight. The information there. They're a couple of years old, but still applicable. Know the history of the property, by talking to the broker or subscribing to services like Yardi Matrix, CoStar, or other platforms. Every property has a story and history, so understand those. Um, just secretly shop the property. Just go, look for an apartment, and look at the property, look at the conditions, look at the management, take a look. So that's why it's important that you walk the property yourself to be able to find those deferred maintenance. Get a sense for, hey, what are the things that you can improve that would translate into an income increase. Know your competition. Who are you competing with? What is the product in the market that is basically you're competing with? And then, as we talked, have a business plan. Business plan for your rehab, repositioning, rebranding, maybe if you want to change the management and things like that. So that business plan, and maybe actually two business plans, are really important. So the typical closing timeline for an apartment is about like maybe 75, 80 days, depending on the loan type, but that's the typical timeline. From the day that you go under contract, typically you have maybe like 20, 30 days of visibility to do the unit walks and look at all the leases and bring your GC, look at the property, get an estimate for different things too. Maybe your attorney, is looking at your title of the property. If you have a lender, you have to do, certain third-party reports, environmental assessment. The lender may want to appraise the property. They look at the physical risk, zoning, etc., etc. Once the property is inspected and you get the information, then you may have to revise your underwriting with the new information, new data, new numbers. Then if you have a loan again, you talk depending on the lender requirement, you fulfill them, and they walk you through the application and the closing kind of requirement. Again, these are like a typical. So how did I purchase the $50 million portfolio of apartments? Um, The straightforward answer is, with my money and other people's money. Definitely, I didn't have the money, and it would have taken, much longer to wait until I have enough money to be able to do that, on myself. So I partnered with other people. I built a team, made a lot of mistakes in building that team, along the way. I raised money directly and indirectly. There are different ways, to do that. Along the process, I found out that it's much easier to raise, larger amount of money, like 30, $40 million than like $5 million. There are more investors out there with those bigger check sizes. That they're willing to invest. Of course, they're not going to give their money to you. They want to know that you have done it, you have the experience, or you have a team. So, the track record here matters. Invested a lot, close to $100,000 in my personal education and apartment investment education. I joined two clubs. It was a real estate investment club, and I spent about maybe $55,000 of the membership, and got the education. And I also joined a family office club. We spent probably around like $20,000 on the membership. They had like certain like classes and networking events that helped me a lot to kind of shape how I look at these things and these deals. Built a lot of relationship with investors, brokers, bankers, lawyers, CPAs, you name it, vendors, and as part of like the joining those clubs, and I met a lot of millionaires and billionaires, and I found mentors, went among like-minded people who knew what they were doing, where they were going, and it helped me a lot. And of course, I made a lot of mistakes, and that's another topic maybe that I can cover and have a presentation on, to tell you how I lost control. How when I built a team, I made assumptions that were not true. And talk about that. Maybe in a different topic, different time. And I would be happy again to share those mistakes with you. So this is how I built it. And of course, this is general. I know some of you might be curious about more details, and I would be happy to share them with you on a personal basis. So path forward. So if, let's say, you decide that the apartment complex is the right asset class for you, and you decide to become an apartment investor, and if you decide to do it yourself, then I'll be happy to help you, review your deal for free. Just send me an email, and I'll be glad to help you, in that process. If you think that you want to be an apartment investor, but you're comfortable with stock market and or stock investing, and you want to do it in invest in apartments through REITs, the real estate investment trust, and that's straightforward. You know what to do. So you can do it through any major stock exchange or your broker, 401k, or any other platform. Uh, but how about doing it together? And the reason I say this because in my experience, again, investment is a team sport. It'll take a long time for just one person to know everything and then go find all the money that they want and they invest. So it's not scalable. It's not I would say realistic, because sometimes we have to give away a little bit of control to be able to benefit from the scalability, and we don't want to reinvent the wheel. To me, again, the holy grail here is good partnerships. Partnerships that will allow us to grow together. And in that regard, if you think about it, remember when I mentioned about the Jobs Act in 2012 and prior to 2012, better investments were only, and even today, were only available to qualified investors. So there are lots of investment that still today you have to be accredited, and they check your finances before allowing you to enter those deals. So 97% of the U.S. population, they're non-accredited. No, and it's a pity because we're living in the richest country in the world, and with our financial system here, why is that? Why only 3% of the population of like 330 plus million people, they're only accredited? And I kind of came across this this quote, and I thought to bring it here that Thomas Jefferson in 1776, when he was drafting the founding document for the United States, he wrote we hold these truths to be self-evident, that all men are created equal, and that they are endowed by their creator with certain unalienable rights, that among these are life, liberty, and the pursuit of happiness. And this is beautiful, and that's why all the signatories, back then they just signed it. But at the same time, if you think about it, when it comes to investment and investment opportunity, we are not all equal. That's why we have these categories: accredited, non-accredited, and definitely we don't have the liberty, in what we do, unless we create it, unless we design it, and that's why partnership to me is the way to go. And along that line, here's my invitation for you. So, as I said, I've spent more than $100,000 on my education with the time and experience, and kind of building the relationships, and I'm willing to bring that to the table. So I've created this investment group, Pradium Investors, that I would like to invite you to join, and work together toward financial freedom. And the idea behind Pradium Investors is that we can definitely achieve alpha above average risk-adjusted returns with direct investments in premium cash flowing real estate assets and operating businesses. So cash flowing here is the key. And definitely, I've seen the power of having like-minded people, around me and on the team. So I'm seeking and I'm inviting you to join if you're like-minded. If you want to be an investment partner with the similar values as here, let's do that. I believe in hands-on approach toward each investment. Each investment is different, and with the power of the team, we can definitely leverage our combined experiences. I don't know everything, and I'm willing to, again, share what I know, and I'm looking forward to people who have the experience and also decide to to see the vision and decide to join this effort and bring their management and operations experience and excellence to the team. Really, the core values here are, this is a business of building relational trust and, committing to it to preserve it. We need to operate with, of course, with radical transparency and integrity. Over communication is the key, and I'm guilty of it because, sometimes I don't communicate enough. And being fiscally conservative and operationally, nimble and agile is something that is part of the value proposition. Of course, with this motto, alpha ambition, premium precision investing with clarity and transparency and purpose. So with that, again, no, these are some proposed return criteria. The IRR of 16 to 22%. This is based on my experience that we can find deals that would fall in this category. Cash on cash 7%, equity multiple like double your money, in like 4 to 5 years. Preferred return on equity 8+%, double-digit return on debt partners 10-15%, and having a hands-on experience management kind of strategy, are the key. And finally, again, we cannot afford getting rich slow. Let's team up together and let's do it together. If you decide to consider joining, please take a look at this link. Fill out the form. This questionnaire is just an expression of your interest, and then we're going to have further conversation. So this is it. Thank you very much for your attention. Please provide your feedback. Ask any questions that you have, and I look forward to seeing you in the future presentations. Have a great day, guys. Thank you very much.